We've mentioned BDCs a few times now, so let's just define what that is for the audience here. When we say BDCs, we're referring to business development companies, and these are closed-end funds that invest and make private credit loans and that are available to retail investors to invest in the marketplace. They have a traded price that we can observe every day, and they also have other characteristics about the fund that we can observe to draw an inference of kind of what this market segment looks like. And so a few things that you want to be aware of, probably first and foremost for investors, is there are pretty high fees associated with making an investment in this space. In general, what we see from these business development companies is they charge about a 2% flat management fee on gross assets. And I say gross as opposed to net because these funds are also introducing leverage to their investment portfolio, and they're charging those management fees on the total assets being invested, not just the capital contributed to the BDC. So a high management fee associated with that. They also have what we'll refer to as an incentive fee on top of their basic management fee associated with investing in these BDCs. Now, those incentive fees, sometimes they'll have a hurdle rate, a requirement that they return a certain rate of return, but that incentive fee is applied to, in general, whatever profits or positive rates of return that BDC collects. They're going to take a portion of that as an incentive fee for their services. Now, often we'll see those incentive fees come out to around 15 to 20% of those positive returns, which for the top BDCs in the last calendar year came out to around 2% of the overall assets under management. So you think about 2% of management fee plus an additional 2% of your asset management of incentive fee. Right there, we're in a different ballpark in terms of the fees compared to what we see in the public marketplace.